All right, hello everybody. Todd here. Thanks for that great introduction and busy market. So let me just see here. Let me get myself situated. We are seeing the volcano blowing, according to Jimmy Buffett. Let me get comments up here, questions, get them loaded. Hubert just came off, so I'm sure Hubert did you guys well. And let's see, Hubert and I worked together a real long time, so hopefully I'll follow up with as good a presentation as I know Hubert gave. So what did I just get filled on? Okay, I just actually covered some shorts there, so that's good. All right. So guys, just give me a heads up. You can see the volcano blowing. You can hear me, and we will get rolling. Awesome. Okay. Holy cow. What a busy market. So guys, we're going to talk about what's going on here in this market. I think, and it's kind of like, it's kind of obvious, but we're in a serious pocket of volatility here, and I'm going to show you guys how we are approaching this market, what to do kind of on a longer term basis. And just so you know, I'm a trader. That's all I've ever done. I'm a short-term trader. But at any time, I'll only be trading actively about a third of my capital. And, the rest of it, what do you do with it here? And, you're not going to be trading all of your money in and out all day long. I recommend you trade 1% of your money, and then you got to put the rest of it somewhere. So this course is about what to do with the rest of your money. What are you going to do with it? I think we're coming up in a serious period of volatility here, and we've got to figure out where to go when the volcano blows. And guys, it's blowing right now. So just a warning, we are talking some dangerous stuff here. This is a very tricky game. This is not a get-rich-quick scheme. I'm going to try to teach you some skills that I've accumulated in my short career. I guess it's 15 years now. And the most important thing right here, guys, is don't trade with money you can't afford to lose, because when you're first starting out in this business, you're going to get beat up a few times. This is a boxing match, okay? You're going to get knocked down a few times. You got to get back up. You got to keep swinging and try to win the decision at the end of 12 rounds. So you're not going to hear me talk about get-rich-quick stuff. I'm going to show you that this job takes work, takes a lot of passion, and that's the only way you're going to make it in this biz. So that's the best warning disclosure I have, but that's really coming from the heart. So that's that. I have a good amount of content, so I'd love to interact with you guys, go back and forth. So I kind of get yelled at by my management and marketing team when I get off topic. So I'm going to be a little bit, I'm going to kind of skip past some of the questions in the very beginning, and if I have time at the end, I'll sit here and chat with you all day. So don't think I'm being rude. So why are we seeing this massive period of volatility here? Well, every time the Pope leaves the U.S., the market crashes. So Pope Francis just left. It happened in the credit crisis, NASDAQ, the long-term capital management, Russian crisis. So no, just kidding. That has nothing to do with it. But fun chart from Business Insider. So a major reason that you're seeing, this huge pocket of volatility is this chart right here. This is the S&P. I believe this is a weekly, probably a monthly chart. The SPY in black and EEM, emerging markets, there in red. And if you take a look, I've got the breakdown of this EEM exchange traded fund. About half of it is Asia. So you got China, Korea, and Taiwan making up just over 50%. And the media's gone all crazy because the Chinese stock market has really dropped pretty sharply right here. Well, what you'll notice if you put your charting hat on is the EEM has not been confirming where the S&P's gone for years. EEM, emerging markets, put in a high in 2011 and have made pretty much lower highs ever since, where the S&P got through the 2011 high like the next year and just kept going. So emerging markets have been really underperforming Western stock markets for years, but it's kind of funny everyone is now all of a sudden talking about it, right? So that's a major reason for volatility. I think this volatility is going to continue. This is a major divergence that I do think needs to be unwound. Okay. So again, just quickly about me. I am Todd Gordon, and my wife Trish, and twin boys Jake and Brody. I am originally from upstate New York, way upstate New York, pretty slow. But I worked on Wall Street and hedge fund and did the crazy city life for a long time, and I dropped out. I'm a corporate flunky. I trade my own account from home, run my research business. I met my wife Trish in Hoboken, New Jersey, when I was food shopping, and then we got married. And yep, he was there. Love him, hate him. He's interesting, but I kind of met him through CNBC, through the TV stuff I do, and whatever you think, man, he's making the debates interesting, right? So I do work at home. My boys, Jake and Brody, they're 20 months now. Actually, no, today they're Fibonacci 21. They're 21 months today. So they're pretty fun. I go upstairs and bother them and my wife Trish to get a break. I work down in the basement. I got the whole office basement renovated, and good spot down here. Not enough windows, but that's life. So. You guys may have seen me. I do stuff on CNBC. Once a week I do a show called Trading Nation, and I've done Fast Money and Squawk Box, and I've been on CNBC over 300 times. So I've got a good relationship with them, and that's that. So that's who you're talking to. Okay, so guys, as I said, we have a coming volatility storm, and is it going to be a crash? Is it going to be a correction? That's the name of this webinar here, and basically, we're in for a major explosion of volatility coming from basically the Fed being painted in a corner. The point that I'm going to make to you here in the next 40 minutes or so is if you're unprepared, this is going to feel like a crash. If you're prepared with the right tools and you know how to handle this and you know how to shift gears, it's going to be ripe with opportunity. As I said, guys, day one out of school, it's all I've ever done is trade. It's really the only business I know. And the one thing I can share with you guys is there's times the markets are slow and just chopping around and or just moving to the upside in a low volatility environment. That takes one kind of trading approach. But when the vol starts to spike, volatility and volume start to spike, you need to change gears. You need to shift gears quickly. Because the volatility means huge ranges. Ranges mean you need to change your time frames. It means it needs to change your trading size. You're going to be a completely different trader in a volatile market than you will in a very choppy or upside market in a low volatility environment. One of the truest things I learned in trading is you will make between 70 and 80% of your money during 20 to 30% of the time. And that's one of the most true things that I've learned over the years. Trading for a living is difficult because a lot of people will sit down and try to budget, their expenses and living money and say, I need to make this every month. That's just not how trading works. I mean, there's going to be 2, 3, 4 months where you crush it, and the other, 5, 6, 7, 8 months where you're just kind of chopping around, make some, lose some, maybe you have a bad month. That's just the reality of the business. So this is a period we're coming up on that. For me personally, I've been through a couple of volatile periods. Knock on wood, I trade pretty well in volatile markets. And we're short now. We were covering profits on the way down here. We just had a really nice run in here. I hope the volatility continues. So I'm going to show you, over here, how we're going to approach this volatile period. So I'm going to do a couple things here. I'm going to show you the background, how we got ourselves in this mess. I'm going to show you some of the major players that are moving around in here. I'm going to give you 3 tools that you can use right away to begin navigating these markets. And I'm going to show you some of the markets we're trading in here. So just a little background. You got to stay with me for about 10 or 15 minutes. I'm going to do a little bit of fundamental stuff. I'm not a fundamental guy. But it's important to realize what the fundamental crowd is thinking about and talking about and what's driving their decisions. And you got to realize is it a good time to go with them, to go against them, or what. So stocks have been rising for years because of the Fed's BS. And BS stands for balance sheet. So this is a fun chart from Zeal LLC. It's a cool website. The blue line is the S&P, and the orange line is the Fed's balance sheet. Basically, what the Fed's been doing is stuffing their balance sheet or their trading account. Let's say the Fed has a thinkorswim trading account, and they're just getting longer and longer and longer bonds in their toss account, which is pressing stocks higher. Okay, so this is a look at the Fed's thinkorswim trading account. So they have a little less than $1 billion in securities, or sorry, a little less than $1 trillion in securities through 2004, 6, 8. Credit crisis hits, they get through $1 trillion, they go to $2 trillion, they go to $3 trillion, they go to $4 trillion, and they're starting to level off. The reason they're stuffing all these bonds in their trading account is they're trying to press interest rates lower. So the blue line is your note, is your 10-year bonds, 10-year note futures, 10-year notes, and the purple line is the yield on those 10-year. And you'll notice they move perfectly in an inverse relationship. As bonds go up, those interest rates go down. The Fed wants those interest rates to go down, so that will have an impact on all kinds of interest rates around the country, including loans on your credit card. The 10-year note has a big impact on where 30-year mortgage rates go, and they also want you buying new cars and new kinds of stuff that you guys don't need. Okay, so why do they want you to do that? Well, the more crap you buy, you know, I guess a portion of Sweet House isn't crap, but the more stuff you buy, the higher the stock market goes, and that makes the Fed happy. The other reason is they're trying to basically force people living on these interest rates, these fixed income investors and people who are living on that fixed income. They're trying to drop that return so low that they're like, dude, I can't live here anymore. I can't live on this, and they just run into the stock market to try to get a return they can live on. So it's quite a scheme. So that scheme, which has been buying bonds, force rates lower, known as quantitative easing, is coming to an end. This is the federal funds rate. This is where the Fed meets every month and they set the interest rate. Last time they hiked rates was back here in 2006, and it's been flat all the way through here. So December is the first possibility that we can begin to move higher. Okay, so the Fed, you know, by building up their thinkorswim trading account to $4 trillion, was doing it with money made out of thin air, just creating credit. Everyone thought that was going to be real inflationary. The dollar would get destroyed. The gold market would be through 3,000, and that is not what happened. In fact, exactly the opposite happened. Okay, so the reason is this is the Fed's preferred gauge of inflation. Its target is 2%. Right here, we're nowhere near 2%. Okay, we're well below it. I mean, we've barely gotten above 2% since the credit crisis began. So, guys, with commodities falling as sharply as they are, that's only going to press this guy lower. What's happening, guys, is the Fed has been basically painted into a corner. They're getting external pressure to stop this craziness of low interest rates and quantitative easing. And I think, guys, the market is not ready for it. Emerging markets, like we talked about, has been underperforming for years. Commodities are on the decline. Bonds continue to remain well supported. And that all spells deflation. Deflation is bad for stocks. Okay? So I think the stock market's in trouble. The Fed is going to raise rates, and they just are not in a position to do so. So let's get into a trade. One of my favorite trades that we're holding in our portfolio, our longer-term portfolio that I'll tell you about here in a second, is the dollar. Okay, if the Fed raise rates and they do it for a period of time and the stock market can handle it, and I'm watching the market off on my other monitor here, the NASDAQ is making new lows here. So if the stock market can somehow handle it, the dollar should do very well because we're going to be the first central bank to raise rates. So that makes our dollar more competitive overseas. So the dollar has broken downtrend resistance and could continue higher if the stock raises, if the Fed raises rates and the stock market can handle it. The other side of this is, let's say the stock market gets crushed and continues to get crushed. Anytime the stock market sold off in the credit crisis, the dollar got a huge bid because everyone around the world was selling their local stuff and coming into the U.S. to buy our treasuries. And you got to buy our dollar to buy our treasuries. So the dollar wound up being a safe haven. So I'm thinking the dollar rallies in either case. Either the stock market rallies as the Fed's raising rates, or the stock market sells off and the dollar winds up being a safe haven. So we're holding UUP, the dollar ETF. That's one of the holdings in our portfolio newsletter that I'm going to talk to you about here in a sec. Yep, UUP, that's the dollar ETF. Yep, exactly. Copper's a great example, Nick, exactly. Copper's gotten crushed, and yep, exactly. Oh, Bree, why do they want 2% inflation? That's a long, long conversation. I'm gonna, if you want to hang on to the end and I still have time, I'll get into that. But good question. I don't have time to do it. And then, yeah, UUP is that. Hey, listen, what do they buy bonds with? Literally, they hit Control P on their keyboard for print. They print money. Control P, and then they buy bonds for their TOS account. Symbol UUP, guys, dollar index ETF. If you want to buy the dollar in the ETF, it's UUP. If you want, you know how you trade stocks? You just buy UUP, and that tracks the dollar. Okay, so let's get into some of the talking heads. I don't listen to a lot of them, but some of them I do. Robert Shiller, he is kind of the foremost authority on housing. He came up with the Case-Shiller Index. He's got a valuation confidence index. Basically, what it shows is people have never been so worried about valuations of stocks as they were back in 2000, right before the crash. He's saying people, with stocks up here at the highs, people are very nervous about valuations, and he thinks the S&P goes to 1,300. So, I mean, that's a pretty big drop. Bill Gross. He's saying American savers are being cooked alive by zero interest rates. Okay, I already described that. With low interest rates, people are being forced into the stock market to get any kind of return. The other thing the Fed tried to do with these low rates is they thought companies would take that cheap money they can borrow and turn around and invest it by hiring new employees and building out infrastructure of their business. Well, they didn't do that. What they did was they played financial games. They borrowed money cheap. They started stock buyback programs, which is basically corporations buying their own stock, propping up their stock price, keeping the board happy so they can secure their jobs. And they also did a lot of M&A, mergers and acquisitions. There's been a big flux recently of M&A. You've seen a lot of deals just being done, and there's been a big flurry because people think rates are going up, and they want to get those deals done with that cheap money before it's over. So here's the deal, guys. These stock buybacks, the M&A, it's going to dry up, and that's going to be a loss of a major kind of propellant for stocks. Well, thank you, John. I hope this presentation is recorded. It's excellent. I appreciate that. And this is all fundamental stuff. Like I'm a trader. Trust me, but you just got to know what the fundamental people are thinking and saying, and sometimes you join them, and sometimes you go against them. So one guy that I listen to that's very controversial, Bob Prechter. Okay, I'm a big Elliott Wave guy. It's how I use to time my trades. It's how I gauge my risk reward. Bob Prechter is the modern day Elliott Wave ambassador. I'll skip to the point here, guys. He sees the Dow going from 18,000 to less than 1,000. I mean, that's insane. I agree. Or is it? People fear what they don't understand and hate what they can't conquer, says Adam Smith, the father of modern economics. So before we call Prechter crazy, and I know Prechter, I've spoken with him and done presentations with him. We actually both got to speak in front of Oxford Business School. I got to lecture the Oxford MBA class in England. And Prechter and I spoke. It was kind of fun. So let's see what two heavy hitters say about Prechter, Tudor and George Soros. Soros, you guys all know Soros, crazy man he is. He says, basically in New York Times, 1987, Prechter told all his subscribers to sell, and Soros says that reversal proved to be the crack that started the avalanche. So he's saying that Prechter started the 87 crash. Speaking of, Soros is holding, in the summer of 2015, he was holding about almost 1.3 billion worth of stock index puts, in the SPY and IWM. So Soros is hugely short. The other guy, Tudor Jones, a little lesser known, but you really should know him. He's my personal trading hero. He's donated over $1 billion to charity. He's worth $3 billion from his hedge fund. And I've been to 2 of his fundraisers. They're called, he runs a fundraiser called Robinhood. And in the last 2 years, guys, I watched him raise $50 million for charity in one night. Last year was hosted by Brian Williams. He didn't get invited again this year, but this year was Katie Couric. Paul McCartney was the music. Like, I mean, talk about the heaviest hitters in the world there. They raised $50 million for charity. That's Paul Tudor Jones. So you might have heard of Tudor in the classic Market Wizards. If you haven't read it, you should. Tudor, quoted right in his book, is saying that's why he's so successful, is Elliott Wave allows him to create incredibly favorable risk-reward opportunities. I attribute a lot of my own success to the Elliott Wave approach. So Prechter also helped Tudor Jones get short for 87. Jones made over $100 million in 1987. That's unheard of. Okay, so these 2 guys appreciate the work of Prechter, and again, Prechter thinks we go significantly lower. So the reason I'm focusing so much on Elliott Wave in here is because we just saw a very key Elliott Wave pattern unfold, ending diagonal, also known as the death wedge. It's an upward consolidation pattern that happens when a move has gone too far, too fast, and they yield huge reversals. They're like unicorns. They're magical if you can catch one, but it's really hard. And again, guys, I see the comments coming through. I'd love to dive in, but I have to get through the content. It kills me to not engage with you. Please understand that. So here's the death wedge. It's a 5-wave move. It's a rising pennant. You guys have seen a million of them, but it's where they occur is what makes the difference. 1, 2, 3, 4, 5 touches on the trend lines. Those trend lines will eventually meet in the middle to kind of tell you the pattern's over. So a death wedge occurred in the S&P. We put this chart out to clients. This was June 17, 2015. We're looking at a fib resistance zone, and this is the crazy Elliott Wave stuff that I do. This is how I time the markets, gauge risk, gauge reward, lay out my plan A, lay out my plan B before I go into battle. So we're looking for fib resistance from 2160 to 2170, which sets up a potential 20% drop on this S&P weekly. So we're looking for 2160 to reverse the market. I had shorts into 2160 laid out there. I had orders to sell. We only got up to like 2130 or 40, and then we dropped. So I missed selling the top, but we did really, really well on shorter term trades on the way down. So here's what I'm thinking going forward. I was thinking we would get down to like 1820 here in the market, then bounce. We only got down to like 1900, and then we bounced. So here's what I think's happening right now, and this is the main kind of point of my whole presentation I'm giving you this morning. Is here's the Elliott Wave count, and this you don't need to understand this. I'll tell you how to handicap this. I'll tell you what all this stuff means. All this means is we should have one more little push up towards about 2400 in the S&P. That's going to complete a larger degree wave 3. Then we're going to drop again, get down into the 1700s, then rally up again to complete 3, then go back down to 1800, then go back up. Guys, I think for the next 3 to 5 years, there's going to be a huge sideways, volatile, nasty range. The easy money is over. I think it's over. I think we're going to a nasty sideways range. So hedge fund managers who just trend follow, mutual funds who obviously just trend follow, they're going to get crushed because it's going to be hugely volatile and sideways. So I'm gearing my business up. Obviously I'm a trader, but I'm gearing up to help people on the longer term. I've got a lot of friends and family who say, Todd, what do you do with your longer term money? I've got several money managers that follow me, and they say, Todd, can you help me with the longer term stuff, timing the market? So that's how this portfolio newsletter and this webinar I'm going to show you was born. So let's get into some trading stuff. Okay, that's the fundamental stuff that's over. Now let's get into how to trade this stuff. So let's take a look at trends. Okay, do you think right now the stock market's still in an uptrend? And just answer that to yourself, yes or no. Do you think we're in an uptrend? So let's examine that. The uptrend that's gone almost 300% in less than 7 years is in danger. Problem is, you can't compare today's Dow to the Dow back in 2009. You can't look at a 1,000-point move in the Dow today and compare it back to 2009. It's like comparing apples to oranges. So I asked you, do you think that the stock market's still in an uptrend? And it's debatable. We're going to come back and we're going to answer that. So to go back on this percent change concept, let's take a look at the Dow from the credit crisis low to today. From the low at the credit crisis, the market rallies up to its first major swing point. Okay, that was a 4,900-point move in the Dow. That wound up being a 78% move from the lows. Okay, 4,900 points. Let's go off the top of the Dow, and let's just take away 4,900 points, and that winds up being a 37% move. So 4,900 points down here represents 78%. 4,900 points up here represents 37%. It's half as significant up here. Okay? To drive this point home, we need to set up log scale on our longer term charts when we're looking at these huge, huge moves. Basically, what it does is it shows a percent change, a common percent change distance, and a similar like physical distance on your chart regardless of where you are on the price. Don't worry, I know that was confusing. I'm going to show you. We're going to put a lot of pictures behind it. It's going to be much easier. So just to drive the percent change concept home, stock goes from $100 to $120, that's a $20 move, 20%. Stock goes from $150 to $180, $30 move this time, but still 20%. $200 to $240, it's a $40 move, still 20%. You get the theme I'm driving at here. When you're looking at long-term charts like this, we need to move to percent change rather than dollar change. Okay, so that's the point. You need to look at log scale to do proper analysis on the longer-term charts, or else your technical analysis levels will be wrong. Okay, so I asked you that question. Do you think the stock market is still in an uptrend? If you look at your default scale, which is called arithmetic, any chart you pull up, you look at that S&P, you know, while we're above 1,700, yeah, we're in an uptrend. But if you change the settings over to log scale, you redraw that trend line, guys, support has been broken. The stock market has broken uptrend support that's been in place for over 6 years. The market has come back. We retested, and we're starting to fail up here at the old highs in the S&P. This is a problem. Crude oil, same chart, default chart, above support while we are right around the $45 mark. But if you go over to log scale, redraw your trend line, support has been broken months ago in crude oil. And I do think we'll move into the low 20s in crude oil. Apple, on the arithmetic scale, support's intact. On the log scale, going all the way back, post-split adjustment basis, Apple's trading about $2 a share post-split. You redraw your trend line, guys, and this one really drives it home. Apple uptrend support has been broken, and it doesn't matter where you draw the trend line, which, by the way, I think trend line analysis is the most subjective form of analysis you can find. Who knows where to exactly start and stop your trend line? Apple has broken uptrend support. IBM, you know, while IBM's above about 110 on the regular scale, you're fine, but IBM, guys, I captured this chart back in September. IBM, I think, is probably 130, 131, 132. IBM has broken support that goes all the way back to like 1997. Okay? We've just lost a serious uptrend in IBM. So, okay. That's the first question. Okay, that's the first tool. Log scale is a setting that's available in all major charting packages. And just to review, all it does is it makes, see the distance between $20 and $40? That's what percent of 20 is 20? It's 100%. So you get a stock that goes from $20 to $40, it's moved 100%. Let me see if I can draw on the screen here, pen. This physical distance that I'm going to draw on your computer screen, on your monitor right now, that physical distance is 100% move in the stock, which is $20. If you looked at a $20 move up here in Apple today, do you think a $20 move up here is as significant as a $20 move down here? Hell no. 100% move up here is going to be huge, okay? So this physical distance represents 100% move. This same physical distance on your computer screen is a stock going from 100 to 200, $100. And when you change that, that is going to adjust where your trend lines come in. That's going to adjust where your Fibonacci comes in. It's going to adjust the size of your candlesticks. It changes everything. Okay. Amazon. Yeah, I could take a look at Amazon, Bree, when we get rolling. Okay. Changing gears here. This is another topic. You can use this on short term, and we're going to talk about this on the long term. Measured moves. As I said, I'm a big fib guy, big Elliott wave guy. Measure moves, two-step patterns, AB equals CD, A wave equals C wave. There's a million different names for this pattern, but it's a really powerful pattern. So what you do is when you're rallying, let's say in an uptrend, you're going to look back at the most recent trend prior to a correction. Okay, you're going to figure out the distance that was rallied in the prior swing in that direction of the trend. So those $30 rally, you want to be looking out for where the $30 rally comes in, because the distance traveled here is going to have an impact on this move. A lot of times it'll act as resistance and reverse the move. Sometimes it just temporarily pauses the move before we extend upwards. You always want to look at your measured move target. It acts as resistance in an uptrend and support in a downtrend. This is CMG, okay, Chipotle, $45 rally up. We set back in a correction. You want to be watching for the next $45 rally. We came up, tested it a bunch of times before we eventually sold off in CMG. DLTR, about $11.50 move up, back down. We hold the lows. We go up. Very simple. Start looking for them. You'll be amazed at how many moves kind of stop at that point. If they don't stop, this is a great relationship, and I'm going to turn you guys into junior Elliott wave and Fibonacci traders here. If the measured move target doesn't stop, okay, so let's say we go from a $10 move in the prior swing, we have a $10 move in the current swing. Let's say we just kind of go sideways for a little while and we don't really reverse from there. Look for the 61% Fibonacci projection higher. That's going to be a nice target you want to trade towards. You could do a breakout trade from measured move up to the 0.618. So what you do is you take your prior swing, and this tool is available on all charting packages. So you just do a Fibonacci projection AB swing, you multiply it by 1.618, you project it up from here. That is going to offer a really nice upside target. Okay, and you're essentially using Elliott wave to trade right there. So this is Cablevision. So you've got a swing AB up, set back. Let's project this AB distance up. That's going to give you the 100%. We messed around here for a while, and then boom, earnings come out, and we go right to the 1.618 relationship. Okay, so it doesn't need to be just earnings, but if you don't get a reversal at your measured move, look for the 618 projection, and that can serve as a nice upside trade target. Bonds. I am bullish on bonds. I have been, and I continue to be. We are holding long bond position. If you do on the 30-year here on the daily, you do this swing up, project it down from the low. A measured move swing puts you up to around 165 in that 30-year bond. That's going to give you right to the old highs here from April. All right. So measured moves are awesome strategies. They give you a fixed target, which allows you to plan exits ahead of time, which is really good for options traders if you're doing spreads. But these two are jeopardized by these generational size moves when looking at daily charts or bigger. Okay, here's a trade I had on in Alibaba. So I was short Alibaba. I had a 63.65 call credit spread on, had some profit in the trade. And I'm looking at this. I'm like, okay, so we have blue dot low, blue dot high. These are swing wave indicators, which I'll show you. These basically tell you where to start and stop your measured moves and your fib. So looking at the regular scale, you can tell I'm on a regular arithmetic scale because the distance, every $10 move is the same 40 to 50, 50 to 60 to 70 to 80 to 90. You know, the distance between each $10 move is not changing, so that's your traditional. So I'm like, do I hold the short here in Alibaba, or do I press it and try to get down to the 1.618? Well, looking at the regular scale, I see the $55 mark as my measured move target. So this distance projected down from this distance is going to be my downside target. So this chart says to hold it. If you switch to the arithmetic scale, you'll realize, dude, we already tested the 100% measured move target. In fact, we just did a double bottom on it, and we started to move higher. I actually made this mistake, and I didn't check the log scale on this, and I covered my shorts in Alibaba higher, so I gave back some profits. Okay, and Alibaba rallied sharply from that measured move target. So when you're looking at daily charts or above, the log scale is really important. Third tool, above average true range. You guys have heard of average true range? This is above average true range. In order to qualify as a good crash or correction, like I believe we're in, we need to test at least the third AATR like prior crashes. Let's look at all the major crashes that have happened, and let's see what they did with this indicator. Okay, so this indicator acts like a Bollinger Band, but these are basically standard deviations, or what we call AATR, above average true range. So the middle line is that's your center line. The first thinner bands, those are your minus and plus 2 standard deviations, and then the thicker ones are your minus 3 and plus 3 standard deviations. So this is the 2008 crash. We got down to the minus 2, and then we just crushed through the minus 3 standard deviation, well through it, and then we moved higher. 2000 crash. This was a lot more orderly. We went down to the minus 2, bounced up, went down, tested minus 3, bounced up, double bottom, done minus 3, and then rallied back up. 1987 crash. We're cruising along the plus 3, all of a sudden, bam. This one only got to the minus 2, which was interesting. The 1987 crash only got to minus 2 before we recovered. 1974 crash. We were up around the plus 2, plus 3, dropped down to minus 2, nice little double bottom on minus 3, and then we rallied back up. Here's the 1929 crash. We're cruising along the plus 3 AATR. We drop down, test the minus 2, bounce back up, eventually get down to minus 3, and we test the hell out of minus 3 in the 1987 or the 1929 crash. Dow gets down to a 40. Dow was trading at 40 at the low of the 1929 crash, and then we rally back up. So what's the point of all this? Here's where we are today. We have not yet tested the minus 2 and minus 3 AATR, and I believe that needs to happen before this correction can be considered over. And I don't think, as I've already said, I don't think it's going to be an all-out collapse. Robert Shiller thinks we get down to 1,300 in the S&P. I don't think so. I think we only get down to about 1,600, but then, like I said, we're going to rally back up in 3, down in 4, back up in higher degree 4, and then there's going to be about 3 to 5 years of major sideways volatility that's going to drive trend following people insane. Okay? So anticipation equals performance, right? Anticipation is the ultimate power. Losers react, leaders anticipate. I love this guy. I think he's great. He actually is the head coach for Paul Tudor Jones. Tudor pays him $1 million a year to talk to him once a week. And that's a quote right from Tony Robbins, and I think that sums up everything we're talking about. If you can anticipate, lay out your game plan here, you guys are going to be pretty hard to beat. But if you're not prepared, and obviously you guys are traders, you're active about your investing. There's a lot of people who don't take the same level of engagement as you do. They're going to feel like it's a crash. So it's your choice how you want to fare. I can bring up some charts. I can show you some positions. I can show you what we're talking about. But if you guys want to continue on, I do have an offer for you. I'm very proud to offer it. It's a good course. We did really, really well. We had over 500 people attend. We've packaged it up, and we have it available for you now if you would like. So I've said it before, if you're not prepared for what's about to happen when the Fed raises rates, when they're kind of forced into doing so, it's going to be stressful, scary, and outright dangerous if you don't know what's going on. But if you're prepared like you will, it's a great opportunity to make money. I firmly believe I'm going to make a lot of money here trading in the volatile times because I've done it in the past. So the deal comes with volatility, though, right? Those volatility means emotional markets, and you got to have your trade plan laid out before the stuff hits the fan. If you're trying to figure out in the middle, it's going to be nasty. Okay, so the course I'm talking about is called Crash or Correction. This is the top 5 tools and patterns every trader must master. Okay, I'm going to show you in this course, and I've done it. It's packaged. It's ready. You can view the course now. Very proud of it. Everything I know about trading and managing money in volatile markets. So I'm going to give you all my tools, techniques, preferred markets I'm trading, and strategies. Remember, you're going to make between 70 to 80% of your profits during 20 to 30% of the markets. As a bonus, this is something that we just started. I am doing a weekly newsletter for my portfolio holdings. I run a day-to-day research business. We trade in and out all day long, but as I said, I want to do something for the longer-term capital that I don't want to be messing around with every single day. I want to leave stuff for longer-term trends. Okay, so we have a portfolio newsletter that is built and ready to go, and I'm going to show you. I'm going to show it to you right now. There it is. Okay. So you guys should be able to see it now. Okay. So we have a portfolio newsletter, and basically what I did is I put $25,000 in a live Interactive Brokers account, and I'm allocating 2 positions, adding to positions, taking positions out. I'm keeping track of every stat throughout the life of this account, and we're going to run this as a bonus to you for 3 months. Okay. Come on back now. Yep, looks like that. Discard. Let me just restart this. Current slide. Okay. So how do you get a hold of this guy? Okay. I've said it before. I'm not going to beat on this. This is not for people looking for the Holy Grail. I'm not going to have you on your yacht with the Wolf of Wall Street by March. But as I said, it's a quality course, 100% money back guaranteed. Okay. Now, if you want, I believe. Oh, I did not save in that link. You know, I don't use options very much, so no problem there in this course. Okay, let me get rid of this. Here are the dates. Okay, for the course. It happened on October 7th. Here's everything you get in the course. You get the Crash or Correction course. It actually wound up being more like 3 hours. Okay, we also, and not included in here, we also did 3 live trading sessions that are recorded. So the content was 3 hours. The live trading was 3 90-minute sessions. You get the log scale Fibonacci calculator. So basically, I'll show you how to do measured moves on those log scales. If you don't have the tools, you just quickly do it. We also have an option strategy selection tool. I'll show you. I'm going to be doing some light option strategies, but this stuff is more geared for people who are long only. If you're trading IRAs or stuff like that. We do hold ETFs that are short ETFs, but obviously you just buy them, so they're inverse ETFs. You get the stop loss, stop trail plan. This is very important, the PAR, percent of your account at risk. And I take the risk management stuff pretty seriously, as you can tell. You guys are going to get, I'll show it to you right now, the position calculator. We spend about an hour and a half of the, more like an hour of the course going through this spreadsheet here. This guy is divided up into quadrants. So basically, I'll take you through an exercise where you need to figure out your risk profile, which means, you know, how much of your money are you willing to risk per trade. So then you'll go through that, figure out your risk profile. You input each parameter of the trade in, and then it spits out how large you should trade, both in options as well as straight stock. Okay, so you put your account size in, come up with your risk profile, You put the parameters of the trade in, and then it tells you exactly how big to trade. You'd be surprised. A lot of you are trading way too big for your account sizes. So I'll show you how to do that. So you get that as well. You get 3 months of my portfolio tracker, and you get the swing wave indicator. That's those purple and blue dots that show you where to start and stop the fib. I'll show you how to do that. So all of that, well over $1,200 for $97, so less than $100 if you guys would like to be involved in that course. Okay, so as I said, you log in, you view the course online, and 100% money back guarantee if you're not happy. We sold a lot of these, and people were very, very happy. The feedback was pretty good. I'm very happy with the way the course came out. So if you like realtraderswebinar.com/Todd, and here's everything you get in there, a big old list, and we had some pretty good feedback, unsolicited feedback from the course. Okay, so really, really happy with the way it came out. You don't need special software except for the swing waves indicator. You will need to upload that indicator, but everything else you can do on just free charts out on the internet. It's a one-time fee. We're not going to auto bill you $97 and you're done. If you'd like to continue on with us, you need to contact us and let us know. So we will be trading stocks, ETFs, some light options, but mostly just stock. Okay, so if you'd like to be involved, that's the code right there, realtraderswebinar.com/Todd. Great value, says Bree. How do you follow after the course? Yeah, so my website is, where's my website? I have 6 monitors going here. I need 9. So this is me. This is my home right here, tradinganalysis.com, and if you guys are a little bit more interested in the shorter term stuff, here's a little secret for you. I do have a pretty extensive members area, trade desk. We send out SMS alerts every time we make a trade. You can take a trial here. They'll charge you $47 for this trial for 30 days. But I would recommend you do this course for $97, and then they're going to give you the ability to get a trial to my main service for just $7. So I would say do the whole course for $97, pay the extra $7 to get a trial to this. So all in, you're in for $104, and you get the course, the trading, all the content, plus you get a trial to this. Or you can just pay $47 and get the trial here. So I would recommend you do the course. Show you, I have a lot of good content in there. And what will happen is once you buy the course, you get access to the home page where you get all the recordings to view, you get the live trading, you get all the content here, and then I start sending you the portfolio newsletter. This is only the 2nd edition of the portfolio newsletter, so this is going to run through January. So if you guys buy it, we'll email you out the most recent portfolio newsletter, which is right here. And we did just add a ultra short Russell position in. Okay, so we went short the Russell yesterday. I'm also trading some Bitcoin. I'm going to show you how we do that. So we're going to hedge your portfolio a little bit. We're going to be trading some Bitcoin. I'm showing you guys exactly how to put money in, what to do, and all that. We are short China. We do have some long stock positions, but we've been hedging it with shorts, and we did get stopped out of one TLT position, which is light, and we're going to look to reestablish that. So that's the offer. I hope you guys find that useful, and I don't know how we're doing for time, but I'll certainly hang around and look at any charts you guys want me to look at as long as there's time, and I know there's somebody coming up right behind me, and I'm sure it's going to be good. It's a really nice lineup we have here for you guys on Friday, so I certainly don't want to take time of the next presenter. Jay Geibel, sorry for pronunciation. That is not Bollinger Bands, AATR. That is a different indicator, and I'll show you all about it in the course. Manny says, will you still be bullish on bonds if the Fed raises rates? Manny, yes. This is interesting. I don't know if I can do this or not, if I have time. Would somebody just let me know how I am for time? I don't want to take up someone's time behind me. So he asked a great question. Will you still be bullish on bonds if they raise rates?
Oh, sorry, Todd.
Say that again.
Good. You have until 12 o'clock.
Okay, perfect. Thanks. So let me just bring up the PDF from the premium class. This is an interesting chart that shocks everyone. So the Fed can raise rates, and that's going to have an impact on the shorter term. The longer term, very few people realize this, is, I'm going to see if I can find this. and I'm scaling through the premium content. Here, I'll do it live for you. As Bill O'Reilly says, we'll do it live. Oh, come on, graphics card. Okay, so this is the premium. I don't mind showing it to you. Wow. Okay. Measure moves, bonds, measure moves. This is the log scale calculator. I'll show you how to do measure moves long scale. The other one we didn't talk about is we do a lot of intermarket analysis here. I'll show you how different charts overlay. This is what I wanted to talk about. My cursor is disappearing. Okay. So check this out. This is the S&P and the bond market, 30-year bonds, since 1979. And I don't know why my cursor isn't showing up. My graphics card's been a mess recently. So look at the correlation below. You will see that there's actually a long-term positive correlation with, oh, come on. There it is. Long-term positive correlation with the S&P. So bonds and stocks, most of the time, are above the zero line. The only two times where they've gone inverse of each other is when basically the stock market has crashed, 2000 and 2008. But if you look at this, traditionally, stocks and bonds trade together. So interest rates have been falling in the U.S. since the 70s. I don't think that's going to stop. The Fed can raise rates in the near term, but the Fed doesn't have control of what happens at the longer end of the yield curve. So I do think the 30-year bond market can continue to rally, and it should rally. Because, like I said, these two circled areas are the only times that stocks and bonds have traded inversely, which was the 2000 crash and the 2008 crash. Okay, and then the other thing we talk about is the art of the trade, which, again, is really, really important. I mean, we do a ton of intermarket stuff in here. How to find ETFs. Where's the art of the trade? Right there. So we get into, how to figure out your risk profile, how to break apart the position calculator, what it means to be your risk profile, what it is you're here to do in the market. So, pretty happy. And then we give you a very specific step-by-step setup on how to trade this stuff. Okay, so that's the offer. As I said, I'm very proud of it, and I think the course came out well, and I hope to work with you guys. So let's see. Let's take a. I'm definitely let me take as many questions as I can here. Right there. Okay. So questions. Okay, as a member, we can email you questions. Bree, yes, you can email us questions, but what I do is below each of my daily videos that I put out with customers, there's a question field, and I answer them every single day. So members area, this is the members area here, daily video. So this was the video from yesterday. I'm sure I had some comments in here. Yep, and then I just answer them every single day. Okay, and then also in there you get the chart room. I outline the most important markets on different time frames. You pop out the chart, put comments in there. Here's the trade desk. You get very specific. Every time I put out a trade recommendation, I keep track of it and we update it throughout. So we just got filled on this Qs trade. We were short the Qs with a 115, 120 call credit spread, and we just bought it back. We took it at $1.35. I just got filled in the webinar for 5 cents. We're going to update that. And you can go back and look at all historical trades. So I'm pretty diligent about that. I'm not a company that just shoots out a bunch of trade alerts and just doesn't follow up with them. I like to keep myself accountable because that's how I get better as a trader. So VFH, dates of the course, it's happened already again. October 7th was the date. It's recorded and available on demand now. So the content of the course is 3 hours. We traded all through October live, and then that's recorded and ready for you to view. And then the portfolio tracker just started last week. We're in the second edition, and it's going to go for 3 months. So you really haven't missed anything. The real value is going to be updating the portfolio for the next 3 months. So you really haven't missed anything. The indicators can be used on TOS, David. Yep. In fact, here's my TOS platform right now. So I have the swing wave indicator set up, and in fact, I don't have it loaded right now, but I have a long-term analysis layout on TOS that I will share with you, so you can just load up the exact same one. Okay, so yes, you can load the swing wave indicator in TOS. Yep, this is downloadable, Joe. Yep. Bree, I good questions. This is pullback temporarily. We are short. We're covering. I do think it's a temporary pullback. I don't think this is a crash right here. I do think we're going to see new highs. How do you continue after 3 months of the portfolio? To be completely straightforward, I don't know yet. I don't know. We might just make it part of the trading analysis subscription and just as a value add, or maybe I don't know what we'll do. It's a brand new product, as I said, and you know, I don't know. Maybe we'll do something cheap, you know, quarterly or something like that. We'll see. We don't have plans yet. Platform that the tools run on. So the only thing, Dave, that requires a specific platform was that swing waves indicator, which is those purple and blue dots, which help you figure out how to do the measured moves. And we have that built for Thinkorswim, TradeStation, eSignal, Motive Wave, Sierra Charts, Ninja, and I think a few others. Yeah. And okay, if you guys want me to take a look at some markets, I got about 3 minutes. NDX, as I said, NASDAQ, we're just short. We just covered that. Bill, that swing waves indicator, I just took you through that. After that, we get a break on monthly fees. No. Swing wave indicator, any bonus available? Yeah, you guys are looking. Yeah, I think $97. There's a lot of material in there. So please don't use options. Okay. Yeah, Amazon, sure. So let's just take a look. And I'll take a couple quick symbols if you guys want. Let's go to a daily reset. Okay, so take a look. So Amazon was outside that +3 ATR and starting to come back. You know, we're starting to have a little bit of an issue here with Amazon. The way you project the downside is you go to your extensions, you look for the most recent blue dot to blue dot low right there. I'm on a log scale, so minimum would be 595, which is 0.618, and then we could get down to 100% at 545 in Amazon. So we have some room to go down there in Amazon. Even Amazon's down today, so that's not good. You know, I am short. I don't think the market's in crash mode yet, but we're short and we're going to stay short. Apple, yep. So actually, I am short Apple. I put that trade on. I do a show on CNBC called Trading Nation. It's live every Wednesday online, and I put this short on in Apple. This didn't even get to a measured move. So you do blue dot to blue dot, back down. I was thinking we get to the 100% measured move, but we failed at 0.618, which is at the -3 ATR. So we're short, and we're going to look to retest down into the 107. So we didn't even get to the measured move. We did a 0.618 of the measured move, and we're dropping. Joe, unfortunately, I don't have it built for MT4, and I should. Yeah, VFW currencies. I am long, as I mentioned, the UUP, the dollar ETF. We have that in the portfolio. In fact, we added to it yesterday. So let me just scroll this over. UUP is right there, added to the position yesterday. We bought it at 25.18. We just added more at 25.17. Stops at 24, risking 3 and 5% of the underlying. We had a max available share size of $455 or 455 shares. We traded 228. The first half we traded another 228, and that's CNBC calling me right now. So yes,